Hello, everybody. This is Zak Gardezy. I'm the host of Money Minutes. I'm also the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and a private wealth advisor. So, here on Money Minutes, I share with you some of the latest market headlines and my outlook for what's ahead. So, for this week's episode, I'm going to cover three of the leading topics in the economy today. So, one of those is the August 1st tariff deadline. So, I'll talk about what that means and what's to be expected. I'll also talk about the latest in earnings season. So we're in the middle of earnings season. This is when public companies report, how did they do in the previous quarter? How is their performance year over year? And they also share some of the latest news that may be undisclosed as it relates to their particular companies. I'll talk about certain sectors that are leading the way and what I think will happen as earnings season continues to develop. And then lastly, I'll talk about the Federal Reserve. There's a lot of discussion happening right now about the chairman of the Federal Reserve, interest rate cuts, inflation. I'll boil it all down to a very short summary as to what's to be expected coming out of the Federal Reserve as they meet later this month. So let's get right into it. So, a topic that's on a lot of investors' minds is the August 1st trade tariff deadline. So, once August 1st rolls around, basically any country that hasn't made a deal yet with the United States will see their tariff rates go back up to the levels that were proposed back in April. And if we go back to April for a moment, those elevated tariff rates caused the equity and bond markets to sell off. And there was a lot of panic happening from really all elements of whether it was US markets or even global markets. And so the White House announced a 90-day pause, giving countries some time to make a deal to potentially get their tariff rates permanently reduced. Now, again, if there are deals that aren't made by August 1st, we should see those tariff rates go back up. Now, there's a lot of bets happening in the market right now. Some believe that the White House will come up with another extension. And then there's also the other side of it that thinks that those tariffs are going to be placed. Now, the question around inflation, which I get a lot, is why haven't we seen a lot of inflation yet, right? These tariffs, we've been talking about it since April and even before then. So, shouldn't we be seeing some bit of inflation happening in the economy? And there's really two fine details that we need to pay attention to that answers that question. Number one, because of the 90-day pause, we haven't really seen those wide scale tariffs get implemented. There have been tariffs here and there, elevated tariffs on certain products and sectors, but a lot of exclusions in certain areas as well. So there hasn't been, again, that wide scale tariff implementation that was announced back in April, which is why partly why we haven't seen such a massive spike in inflation, and also why the stock market has stayed relatively stable, actually gone up significantly since its April lows. The other reason why we haven't seen inflation spike up, and this is more of a long term factor, is that when it comes to trade tariffs, tariffs of course affect countries, but then they boil down into products and sectors as well. So, depending on the competitive nature of certain sectors, it might not make sense for companies to increase their prices based on the tariffs that they have to pay to the United States. It might price them out of the market compared to maybe the US based competitor. So, in some areas, you might not see a significant price increase, and in some areas, you could. Overall, as that trickles into the inflation reports, such as the CPI reports or PCE reports that we look at on a monthly basis, this might not actually result in a serious spike of inflation, which is why, as I'll talk about a little bit later, you have the Federal Reserve, which has really been hesitant to take any action on interest rates. So ultimately, on August 1st, we're going to see potentially uh, tariffs return, and we may see if those deals aren't made with key trading partners such as the European Union or China. We could see a lot of volatility in the markets as those elevated tariff rates are put back on. Conversely, if we see serious volatility, that could be a great buying opportunity for some investors who are in cash or maybe waiting to get into the market somehow. That's one way to look at it. The other is, there's another opportunity about the White House potentially making some more extensions or figuring out another way to put these tariffs off a little bit longer, which then could be a catalyst for the markets as well. There's certainly a part of the market that's betting on that. So, a lot to pay attention to as August 1st rolls around, but it will surely be spoken about a lot more over the coming days. So earnings season is off to a pretty good start. 12% roughly S&P 500 companies have reported earnings, and of those companies, 83% of them have reported a surprise positive earnings per share announcement. So this is great news so far, and there's a lot more companies that are yet to report. But as we're tracking this on a weekly basis, according to FactSet, there's some really positive momentum building in earnings season so far. The earnings growth rate is actually higher than expected, but it is a slower growth rate than we're used to. It's actually the slowest since Q4 of 2023. So there's a lot of different ways you can look at it, but overall, that's very positive. And then moving on to more of a sector based outlook, you have the communication services sector reporting the strongest growth rate so far. But a huge part of that is Warner Brothers. So their year over year earnings growth rate is sort of uh, inflating the communication services growth rate, mainly because of some accounting based adjustments. They had some impairment charges last year. And once you factor those out, communication services actually doesn't have the highest growth rate. It's actually information technology, or as we call it, the technology sector. So if we really look at it, by taking Warner Brothers out of the equation, the technology sector is by far the strongest sector so far reporting this earnings season. And that's being led predominantly by the semiconductor and chip market, which if we bring that back to the Wealthstone, investment thesis, which has been the case from 2024 and this year as well, artificial intelligence, which is what drives the semiconductor chip market at this point, is again leading the way and helping these chip companies produce really strong numbers so far this year, with, of course, many of the big players still yet to report. But overall, it's been a really good earnings season so far, positive start, and a big reason why the market continues to hit all time highs and continue to have a really good year. So, really good news coming out of earnings season so far. So there's a lot of drama happening at the Federal Reserve. Some of it is economic, some of it is political, and we'll dive into all of it. So, on the economic side of things, there's a lot of questions going around right now as to why hasn't the Federal Reserve Chairman or the Federal Reserve as an organization lowered interest rates. Now you might be wondering, well, what's the value in lowering interest rates? Well, ultimately, when the Federal Reserve lowers the federal funds rate, this eventually trickles into lowering interest rates across many other parts of the economy, whether it's auto loans, mortgages, credit cards. Of course, the Federal Reserve doesn't set those individual rates, but when they lower the borrowing costs between the Fed and the banks, this ultimately reduces the borrowing costs and the cost of funds across the board. So then, when you have lower mortgage rates, for example, you have more home ownership, you have more overall real estate activity, maybe more renovations, people taking out home equity credit lines to buy second properties, maybe starting a business. When it comes to auto loans, you have more activity at car dealerships, more vehicle purchasing. You have, with businesses, more business startups. You have more business expansions, businesses selling and buying, mergers and acquisitions, etc. So overall, economic activity increases significantly when interest rates come down. Just like how when the Fed raised interest rates, they intentionally slowed down the economy. Of course, the opposite happens when they lower interest rates. But everything I just mentioned ultimately results in higher inflation if it happens too quickly. And so the Fed is very sensitive to this. They just spent the last few years trying to bring inflation back down to 2%. They're still not at that target. So, this pressure to lower interest rates is putting a lot of stress on the Federal Reserve. But central banks around the world have already started lowering interest rates, and they've been doing so for quite some time, even though they did not achieve their inflation targets. A lot of central banks around the world just threw in the towel and said, "Hey, look, probably not going to hit this inflation target, so we shouldn't over stress the economy and tighten things too much because that could break other parts of the economy, such as the labor market or just economic growth in general, or maybe make those economies disadvantaged compared to others." So this has caused a lot of frustration from the White House because if they do get lower interest rates as we head into the midterm elections next year, this will be a great win for the White House and something that they could talk about. The economic growth from lower interest rates, lower mortgage rates compared to maybe the last administration. There's just a lot of different ways they could spin this from a political standpoint that the White House is really pushing the Fed to lower interest rates. And in a way, despite what the potential negative economic impacts of this could be. Now, there is a debate happening right now, which is important for those to think about, which is a huge reason why inflation is so elevated, which is, above the 2% target, is because of higher rents, right? And so if you take that out of the equation, or if you somehow try and normalize uh, rent inflation, or the inflation of the cost of living, the overall inflation rate is actually near 2%, or maybe even below it, depending on how you calculate that. So there is the debate of, well, if interest rates were lower and if borrowing costs were lower, mortgage rates were lower, would we be seeing this much higher rent growth that we're seeing across the economy? Because if people can't buy homes, right, because mortgage rates are so high and they're forced to rent, this gives landlords a huge advantage where they can just keep raising rents. And then ultimately, this keeps feeding the inflation fire. And so, would lower interest rates and lower mortgage rates ultimately lead to more home ownership and maybe slower growth on rents because there's less demand to rent properties? So that's a really serious debate that's going on. It's not like it's going to really lead to any sort of answers. It's one of those things that we have to just try it and see what happens. But the Federal Reserve is very hesitant again to lower rates because of the inflation risk, but also because of the tariffs. So you had these massive tariffs announced back in April. There was ultimately a 90-day pause announced, as I talked about earlier. Well, now, depending on what happens with deals over the next few days, we could see some really serious tariff implementation starting on August 1st, which we haven't seen so far. So we haven't really seen the impact that tariffs could have on inflation, if any at all. So the Fed has been really hesitant to just start lowering rates and potentially causing their own inflation if the tariffs would cause inflation as well. Then you're going to have inflation from both sides. And then even beyond that, you had the one big beautiful bill pass, which is really stimulating to the economy as well. And that in and of itself is inflationary too. So the Federal Reserve is looking at this from all of these different perspectives, and they're taking the cautious approach of just waiting to see what happens before they lower interest rates. But it's a very valid concern that I hear from a lot of people on the other side of the debate, which is, if the Fed continues to keep interest rates elevated, could they eventually break other parts of the economy? Could they, again, hurt the labor market? Could they disadvantage the US economy compared to other economies around the world? That's a valid point to make. And so this is why you see a lot of political back and forth going on with the Federal Reserve right now. It's ultimately pressure being put on them to lower rates. The next Fed meeting is on July 29th and 30th. So on the 30th, we'll hear from the Fed chairman. At this point, according to the CME Fed Watch tool, which again tracks, what the market thinks will happen with interest rates, there's an overwhelming expectation that the Federal Reserve will keep interest rates where they're at. And then the next meeting after that is in September, which is when the first rate cut is expected. And then there is an expectation of another cut at this point in December. So two 25 basis point rate cuts at this point for 2025. Now, there is a lot of discussion as well happening around the topic of removing Fed Chairman Jerome Powell from his seat. Now, the White House doesn't have necessarily the authority to do that just for no reason. Technically speaking, it has to be for cause. Explicitly, that's what the language says for removing the Fed chairman, and it's never been done before. And that really doesn't mean anything these days. There's a lot of things that we've talked about this year that has never happened before. And so it wouldn't surprise me if the Fed chairman is removed, or if he decides to step down on his own just to, please the president and let somebody else take his seat. Chairman Powell's position technically ends in May of 2026. So it's not like he has a very long term left, anyways. The risk to the markets, though, is that an abrupt change in the leadership of the Fed is really destabilizing to the markets. What does that signal? And then who takes over for the Fed chairman? Is it somebody who just agrees with everything the White House says and then just slashes interest rates down to 1%, as it's been reported, is what the White House wants? If that's the case, that could be a really bad thing for the markets as well, because the markets want an independent Fed chairman. They don't want anyone who can be pressured politically from either side of the aisle. So that's the big concern around what's happening with the Federal Reserve right now. It's What are they doing with interest rates? What's their overall outlook? Are they going to bring some relief to the markets if they think it's appropriate? And then what's happening with Chairman Powell? Will he stay? Will he be removed? Will he resign? These are all factors that will have, reverberations in the market depending on what happens. At this point, the latest statement from the White House, which was released today, actually, is the time of this recording, which is on July 22nd, is that the White House will just let Chairman Powell serve out the remainder of his term. So that alleviates a lot of the immediate concerns about removing the Fed chairman. But again, things change rapidly. That's at least the discussions that are happening right now. But overall, as it relates to the Federal Reserve, hopefully this segment laid out what the latest is on what's being discussed with the Fed, what the outlook is on interest rates, and then what investors should be paying attention to. And this concludes this week's episode of Money Minutes. I hope you found this information to be useful. And if at any time you have any questions, please feel free to reach out. Thank you very much.